how precious metals can hedge and insure against inflation. Out of the handful of countries where hyperinflation skyrocketed and made national currency worthless, Zimbabwe is perhaps the most infamous. Headlines have pegged the economic issues of the nation squarely on the late President Robert Mugabe, but playing political scapegoat won't change the fact that the numerous macroeconomic factors have contributed to Zimbabwe's plight. Even if the world has written off Zimbabwe as a failed state, a recent headline points to just how valuable precious metals are. Russian and Zimbabwean investors behind a $2 billion mining project got some great news as African Export-Import Bank has cleared their Great Dyke Investments GDI mine project to participate in a $500 million syndicated funding program, Bloomberg reported on September 22nd. If the scope of the GDI project and Russia's involvement doesn't pique your interest and raise the upside for precious metals as investment, not much else probably can. For comparison's sake, GDI's access to bank money is just $100 million short of the $600 million being pumped into the US-based trading platform Robinhood. Those are huge financial commitments, and you bet they are signals to what investors see on the horizon to produce handsome returns. Equities and commodities, such as gold and platinum, may be prioritized differently depending on which nation you live, but the identity of both as a safe haven asset is assured. How exactly do precious metals work as a hedge against inflation or hyperinflation? Hyperinflation is uncommon in the West, but in a besieged nation such as Zimbabwe, it's the reality. With 700% inflation rendering the local currency useless, foreign exchange is conducted in precious metals and diamonds. Many investors traditionally see precious metals as hedges against currency debasement and a downturn in equity. Risk is omnipresent due to potential dollar debasement or even removal from its perch as the top currency reserve asset. I've talked about this before, and it's a topic of concern discussed in financial circles worldwide. Though unlikely to happen, it's a reason to consider taking inventory of your portfolio and pulling the trigger on the decision to diversify with precious metals. Research backs the gold and silver status. There's a historically quantitative approach to grasp the roles of precious metals as a hedge or insurance against equities or other investments. Writing for Seeking Alpha, the director of research for St. Louis-based Buckingham Asset Management, Larry Swedroe, cited this study, Hedging Geopolitical Risk with Precious Metals, published in the Journal of Banking and Finance August issue. The authors of the study, Dirk Bauer and Leek Smollett, produced a timely and comprehensive study that links geopolitical risk and precious metals prices. What they found was what I've known for years. Gold and silver have some ability to hedge geopolitical risk, they concluded, writing that it is worthwhile for investors to buy and hold gold and silver as a hedge. Swedroe leaves room for the unknown by including this quote from the study. Given the results of the test of trading strategies, which did not even include trading cost, it does not appear that one can use signals on geopolitical risk to shift allocations. If there was ever a splash of water to the face when you're thirsty, this is it. Ultimately, it doesn't take an empirical researcher to look up the historical price charts for gold and silver, watch and learn from YouTube videos, read mainstream and business media, and conclude that precious metals are commodities that have served investors well in the past and will continue to do so in the future.